Two hotter than expected economic reports out today. Producer prices ticking up in August, mostly driven by rising energy costs, and retail sales also topping expectations, proving that the consumer is still resilient. That was also driven higher by gasoline prices. Joining us now, we want to bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's good to see you. So when you take a look at the market's reaction, yes, we also had the public debut of ARM today, but focusing first on the econ data prints out this morning, it seems like investors maybe are taking this as the Fed is likely to pause next week, hold rates steady where they are. Do you agree with that?
I think the market is increasingly convinced that the Fed is done. And now maybe with the signal today from the European Central Bank that all the major central banks are now finished or very close to being finished with rate hikes. And that's a bit of a relief. But boy, if you take a look at what the market's priced in, we've got the VIX now below 13. We haven't seen volatility this low since pre-pandemic period. So the market's certainly pricing in clear sailing from here. And it may not be that smooth of a ride.
How big of a concern are these higher oil prices? I mean, I realize that the Fed looks specifically at core inflation, which strips out energy and food. But, we have seen those prices go higher as a result of higher oil. At what point does that start to weigh on the outlook?
Well, it does feed into just about everything, whether you're talking about transportation of services or goods, or even if it isn't a direct component, energy matters. And, if you take a look at where we are now in the earnings season, about to enter the pre-announcement season, I think that's noteworthy, particularly in the discussion you just had about airlines. We're seeing some of the formerly healthy service sector of the economy begin to show some signs of weakness. Airlines are an example. American cut its third quarter guidance because of those higher fuel prices. But we're also hearing about weaker demand as this post-pandemic surge in travel starts to slow. In fact, I think Spirit Airlines talked about steep discounts in travel booked in the second half of Q3 ahead of the Thanksgiving holiday as that binge begins to slow. Student loan repayments come back, tighter credit from businesses, and of course, higher gasoline payments. Now, airlines are a tiny part of the overall market, but the read across to other consumer businesses and companies with oil as a big cost is important as we move through the next couple of weeks here in this pre-announcement season. Maybe more confessions could weigh on the market.
So, Jeffrey, what do you think the potential fallout then looks like?
So I think as we look through the next couple of weeks, I think there's a potential for some higher volatility here. The earnings picture isn't likely to improve very much. I think what we're seeing is broader weakness. Sure, the retail sector's still doing okay, construction's okay, but manufacturing remains mired in a recession and the service sector is slowing. I'd also mention there are things like extreme weather weighing on the markets. And I don't just mean the hurricane moving up the East Coast. I mean the Panama Canal, which is really being impacted by a drought. We're seeing fewer ships and smaller ships being able to transverse the Panama Canal. That's 40% of U.S. Imports exports traveling through there. There could be bottlenecks, maybe supply chain issues as we look to this fall and into the winter, maybe holiday shopping season. So I'm worried about a number of these factors snowballing into maybe a more negative outlook and rocking the VIX out of this very calm level below 13 it's in now.